Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Welcome to episode 4. This is going to be a great episode. I'm really excited for this topic. It's one of my favorite metrics, cash. So today I'm joined by Audrey Giannini. She is one of our CFOs, and Jody Grunden, our CEO. So let's jump right into this topic. Audrey, I'm going to start with you. So with cash, the reason it's my favorite metric is because it helps all the other metrics work and flow. So why don't you start off by telling us how much cash we should have in the bank?
Yeah. First, I'd like to say good job. You said my name right. I'm proud.
I practiced all night.
So proud. So as it relates to cash specifically with our digital agency clients, really our recommendation is 10 to 30% of revenue. So if you have at least 12 months of history, you want to look at the last 12 months of your running revenue, take that, multiply it by 10 to 30%. There's a logic behind whether you want 10 or you want 30 or somewhere in between. And that's how much cash we would like to have as an operating reserve in your bank account. There's a number of different accounts that we recommend, so we can get into that as well. But as it relates to the amount, that's the number that we suggest is 10 to 30% of your trailing revenue.
So 10 to 30% is the starting point. So Jody, if you want to go into some of those differences between a 10% company and a 30% company, so that our listeners know where they might fall.
Yeah, for sure. So basically 10% equates to about 2 months worth of expenses. So if they say, hey, I want 2 months worth of expenses, the quick math is 10%. There's actually a formula you can do to actually come up with the exact number, but it equates to about that for the majority of our creative agencies. 30% equates closer to 6 months. So if you want closer to 6 month reserve, then you want about 30% of your revenue. So if you're $1 million company, 30% of it would be in cash. When Audrey mentions your cash reserve, that's both your operating cash account and your cash reserve account. So there's two accounts. The operating cash account, typically you want about 2 payrolls worth of expenses. Again, something very easy to know. Most owners know how much their weekly payroll is. And so you want 2 months of that in there, or 2 payroll cycles in the operating account. And then the rest of it, put it into that cash reserve account so that you can earn some interest on your money. So it's just not sitting there flat. And then the question always is, how much, like you mentioned, how much should I keep as a company? And every company obviously is completely different, right? So if you're a very well capitalized company that has a ton of cash in the bank, have high recurring revenue, one owner, you've got no clients at over 10%, well, then you're going to need close to that 10%. But if you're a client that has multiple owners, where maybe you're in a high growth stage, or maybe you got some retiring partners, or maybe you're going to build a building here soon, or need some cash for a certain reason, or maybe you think, the big R word's coming up here, the big recession word's coming up here. Well, then maybe you need a little bit more money in the bank there. Maybe it's more closer to 15% or 20%. So it's really based on, how much money you have in the bank. And I've got a book that kind of goes through that in chapter 1 of the book. It talks a lot about that, working capital requirements. It goes through each of the different ones, which covers exactly, what we're talking about there.
One of the things that Jody mentioned that I think is a good thing to dive into, because we see it a lot with our clients, is client concentration. So we said, if you have a client that's nearing that 10%, so what that means is of your total revenue, if 10% of it is representative of, one client, or maybe even more than 10%. I mean, we see a lot of clients that'll come in and have one huge fish that is 50% of their revenue. And if that company is gone tomorrow, they're in a lot of trouble. So if that's the case, if that's you, we definitely recommend having closer to the 30% just in case that client goes. And then the other thing we would say is try to get some other big fish.
Yeah, and to add to that, like what Audrey's saying is, and just so that everybody's in the same perspective, if you've got a big company with many subsidiaries and you're doing jobs for all these different subsidiaries, you still have that one big company. So if the big company says, hey, we're going to cut back, well, guess what? All the subsidiaries will then cut back as well. So it's not that you've got 10% and all these little subsidiaries is 10% in the overall company. So that's what you have to really be careful of. And it happens quite frequently for a lot of different reasons, that people will just all of a sudden, have a great relationship, and that relationship goes away. Nothing to do with them. It could be that they've got, upper management, a changed upper management, and they're bringing their people in to now do the work. So it could be nothing that you're doing wrong. It could be you could have a great relationship today, but because you have that high concentration risk, you really do need more cash in the bank because you need more reactive time. Because if you don't have that reactive time, you start making really bad decisions because you've got to make them right now. Whereas if you have cash, it delays that process. You've got an opportunity to think through it, really use strategy, think of all the consequences, really go through all the scenarios, and then make a decision, which is much more beneficial, much more profitable, obviously, for a company that would lose a client like that or have that type of risk.
Mm-hmm.
Yeah, it's great you mentioned reactive, Jody, and I think that's definitely part of the cash reserve. And I do think that having that leverage not well, has hurt a lot of clients. Had that one project drop through and they don't have cash in the bank. And before we know it, like we're drawing on the line of credit. We're trying to figure out if we can make payroll or not. So I think reactive is a great part of cash reserve, but there's also the proactive part of it. And I think that's really important. So one of the things I always think about is how aggressive are we going to be as a business? So if my owners want to take a lot of risk and they want to try a lot of different things, then I want to have more cash in the bank because sometimes those risks work out and it really accelerates the company forward. But sometimes they don't work out and we don't want it to bankrupt the company. So that's the other part of it too. So I think that is key.
Yeah, like one of the big risks you talk about is that business development person that comes available. Mm-hmm. And you may be like thinking, hey, this is a good time to transition out as an owner and hire that business development person. If you're low on cash, we're going to tell you 9 times out of 10, can't take that risk. That you don't, that's not a risk you can take. But if you're cash flush, or you've got 10%, 15%, well, they're going to say, absolutely take that risk. It doesn't work out. You can let that person go down the road. It's not going to cause you a lot of, turmoil inside the company, or it's not going to put your company at risk. Because again, cash alleviates risk or helps alleviate risk.
Yeah. And also I think on top of that, all the other metrics we're going to talk about in this podcast and we're going to go through, a lot of times they don't really matter that much if you don't have cash in the bank because I can't really read them. I can tell you the changes you need to make, but you don't have the time to make the changes because the cash is so short. And so I think that's, they really do work together. So another important part of cash is monitoring your cash. So one of the things that Summit does a lot is cash flow. We look at cash flow. We look at short-term cash flow. Audrey, can you talk a little bit about that process and how our listeners can do that for themselves and really dig into knowing what cash is going to look like in the future?
Yeah, absolutely. So the way that we do it is we basically every single week we will look at both your payables and your receivables to see what bills you have coming due, when they're due. Your receivables, same scenario, when you're going to get paid by your customers. And it may not always be the due date. I mean, maybe that a customer always pays late. So you don't want to necessarily assume it's coming on the due date if they always pay 30 days later. So that, that kind of helps you understand where your cash is coming in and out. And then we really try to look at the balance over, in general, we look at it over the next 3 months, but really it's over the next 6 to 8 weeks is when you have a really good idea of where your cash is coming from. And then you'll want to look at consistent payments. So any bills that you pay, whether it be every week, every other week, every single month, go ahead and prepare for those and know when they're going to be coming out and try to set up a schedule to understand what your cash balance is going to be over the next 6 or so weeks. And if there's anything that you need to do, if you see a dip in cash and you understand that's coming, maybe you reach out to that customer that always pays 30 days late and you ask them to pay early. Or maybe you cut back on some expenses because you can see that the dip is coming. So those are conversations that we try to have with our clients every single week regarding what big payments we have coming up and how to prepare for them.
Great. So Jody, Audrey talked a lot about kind of the short-term forecast. What do we do for a long-term cash forecast so we can kind of see what's my cash going to look like in 6 months, 12 months, 18 months from now?
Yeah. So the long-term, again, Audrey's talking about basically a roughly 13-week cash flow forecast, and that's going to cover the short-term needs. However, you need to really extend that, like I said, over the long term, whether it's a year, 6 months, 2 years, 3 years. You need to really see what your company is going to be cash flow wise over that period. So it's really easy to start, or actually, I wouldn't say it's easy, but a lot of companies put together some sort of budget, to actually figure out what do we think we're going to do for next year, that type of thing. The problem with just simply a budget is that it's static. You're looking at the end of the year and say, oh yeah, we were close, high five, or we were way off, we won't do that again, that type of thing. Whereas what they want to do is they want to put together a dynamic forecast. And what I mean by dynamic forecast is a forecast that changes on a regular basis based on circumstances or based on real life stuff. So for instance, when we put together that forecast, we want to make sure that Revenue is based on something tangible, not just
Mm-hmm.
simply we hope to have 10% increase in revenue. It's actually, hey, here's how many widgets we have to sell, or here's the service mix that we have to do. And because of this, it's going to generate X amount of dollars in November, X amount of dollars in December. And then we can line up our expenses accordingly. If we're looking to increase revenue because we know that our pipeline is extremely strong and it's saying, hey, it's time that we actually bump things up a little bit. Well, then we know how much that person's going to cost when we bring that person in on the cost side of it. We know how much extra revenue that person's going to generate by bringing them on. So it's really important to have that really solid forecast based on real life information. And again, that's important that it changes because it changes every time. And so once you've got the revenue side figured out, plotting in the expenses is fairly easy. A lot of times you have those, you know what those are, when they're going to hit. And that's important to actually plan it out again according to when they're going to hit, as opposed to just spreading payments out over the entire year type of thing evenly. That never happens, obviously. So you have to kind of plan a little bit there. And so you'll know what your bottom line is. And the bottom lines are really only there for tax purposes, or how much, what we're looking at the bottom line to see, hey, how much money are we going to pay for tax? Well, the flip side of the financial statement is the balance sheet, which is the most important thing to look at, because that's going to tell you where you're at any particular point in time. And so that's going to tell you what your cash balance is in each of those simple months. If you do your forecasting correctly, you should know exactly how much cash you're going to have in November. You're going to notice in December that, hey, you're going to be negative cash, meaning that you're borrowing on your line of credit because of circumstances. And then, January going to rebound because you've got all these deposits coming in, or whatever that might be. It's important to understand that cash flow going out at least on a 12-month basis, if not, a lot longer than that. With ours, we're kind of crazy with ours, obviously, being CFOs. We have ours out 10 years, so that kind of gives you an idea on where we're at there based on stuff. And it's kind of fun to kind of seeing how each month actually changes, what the outlook's going to be. We had a really crappy month last month because we lost a few clients or whatever, and we say, so that's going to negatively impact cash, in December, but not bad enough to where it's going to really dip into being below our reserve, or something like that. Or we had a really outstanding month where we picked up 6 brand new clients. How is that going to impact things? Well, we need to look to hire. And so in doing so, then we can kind of see, hey, we can kind of plot that out and see, okay, based on that, when can we hire that person? When's the best strategic way? Do we stagger the 2 people that we need to hire? Do we hire them both at the same time? What's the best scenario? So it's important to have that really forward-looking forecast put in play. And it really goes alongside the short-term cash. So you have the short-term cash, and you also need to have that long-term cash flow.
Yeah, definitely. I think a lot of companies budget, right? A lot of companies build their budget for the year. I'd say about half of those companies forecast. Not a lot of companies forecast, and then even less actually forecast their balance sheet. And so I think that's the important thing that Jody's talking about is, okay, it's great to know what your P&L is going to look like, but what is my cash going to look like, especially when you're planning for something. You want to buy a building, you want to hire a biz dev person. Like, when can you do that? And forecasting the balance sheet's a key part of that, because we want to have that cash reserve in place before we do that. And so, okay, 6 months from now, if everything goes as planned, I can actually make that purchase. And so I think it is an important thing for a lot of people to think about, is forecasting that balance sheet for sure. So, Audrey, when you were talking about the short-term cash flow, you talked about 3 inputs. You talked about the accounts receivable, you talked about the accounts payable, and you talked about the recurring expenses. And so recurring expenses and accounts payable, not a lot you can do on those. I mean, you can pay your vendors late, but a lot of times that's not a great thing. So let's talk about the one you can impact the most, accounts receivable. And this is a very common question among all the clients that we work with is, how do I get collections a little bit quicker? So what tips could you give our listeners for that?
Yeah, actually, this is very timely for me. I just had a meeting with a client to talk through their very large receivables balance and collections and what we can do to make it better. And the number one word I would say is consistency. So when you have a new client come in, you want to set up a plan with them, tell them what to expect as it relates to your receivables process. So, we're 3 days before your payment's going to, be due, we're going to reach, or back it up even further. We're going to send out an invoice. Our net payment day, let's say it's 7 days. 3 days before the payment's due, we're going to be reaching out to you. On the day that let's say the day after the payment's due, if we haven't heard from you, we're going to reach out to you again, and not only tell them that's what you're going to do, but then actually do it. If the client knows that every single time you're going to be reaching out the day after the payment was supposed to be due, and they hear from you every single time, they're much more likely to pay for it, to go ahead and pay on time, because they don't want to get that phone call. They don't want to get that email. Nobody wants to have that conversation. So they know consistently you're going to do that every single time. There's no question it'll better your receivables process. It's a pain, but it's absolutely worth it.
Yeah, to kind of add to that, it's kind of funny. I just spoke with a client yesterday that their admin person's been gone for 4 weeks and they haven't been invoicing at all.
Mm.
And they didn't even think about it.
Oh,
It
wow.
was one of the things that I was like, well, they didn't even think about doing
Gotta
it.
get paid.
And so now I guess it's going to happen to their cash. Their cash is going to definitely dry up because,
Mhm.
you're taking 30 days of invoicing out of that whole mixture. It's going to really hurt cash.
Yeah.
Yeah, if I had $1 for every client I talked to that said, "Oh yeah, we have penalties, but we've never enforced them," like I wouldn't be doing this podcast right now, because that happens so often that people are just don't, they have penalties in place but never enforce them. So that's one of the things that you can enforce. And the other thing you can enforce is stop work, right? Like you don't want to do that because obviously it impairs the relationship, but it is some leverage you have on your customers. They want you there for a reason. They're trying to get something developed. They're trying to do some SEO work or whatever it is. And if you say, "Hey, if you don't pay us within 5 days of that due date, then we're going to stop work." So that's the two things that you do have in your toolbox that the clients do care about. So one of the things is, to Audrey's point, make sure you do them. The worst time to start doing them is when you need cash. Because like I've been working with the customer for 12 months now and I've never enforced them. And now I need cash. So I'm going to start enforce them. First, they're going to know you need cash. And second, like it's going to really hurt your relationship. So I think that was a great point.
And I would say if you're going to do that, where you're going to pause work, make sure that you tell that in the very beginning when you're actually negotiating the contract. That don't let that be a surprise to them. So if you're going to do that and that's going to be your thing, which I completely agree with Jamie on that, I would say, hey, just to let you know, if we get lack of payment for 5 days for any reason, then we're required to stop until we do get caught back up. And just so they know up front, and then give them a warning. Don't just give them 2 days later. If it's 5 days, that's a pretty small window. But let's say it's 15 days. 5 days in, just real quick warning to accounts payable, whatever. So that again they're not shocked or surprised, but they're well informed, and then it's not a big deal at all. They understand it's business to business.
And then similar to what Jamie said with the interest and penalties, if you say up front that you're gonna stop doing work, you got to actually stop doing work. If whatever your word is, whatever that is that you're I guess warning them of, you got to actually do it in order for it to have any impact on your receivables.
For sure. And I think the other thing too that's key in this area is know who you're talking to. A lot of times, you're just talking to an AP department and they don't really care about the project. But if you actually talk to that person, you talk to the head of the technology department, whoever you're working with, and say, "Hey, your AP department's been late paying us every month," they will go in there and they'll have that relationship and they'll go talk to them and say, "Hey, we need to start paying these guys quicker. This project's super important for our business." A lot of times the AP department doesn't even know, they don't even care what you're doing. You're just a name on the invoice, right? So like talking to those, having your PM talk to those people is really important and helpful as well.
Yeah, one of the creative agencies, because we speak all over the place. One of the creative agencies I'd mentioned during one of the different sessions that as soon as the job is secure, they go and actually introduce themselves to the AP department. So they'll introduce themselves, so they put a name and a face, together, and then maybe every once in a while they'll send them something, like a box of cookies or whatever, as a hey, thank you for everything, just again so that they know who you are versus just simply a number on a page. And so, any little thing like that, really goes a long way. And especially if it's a bigger client where the dollars are really big. Obviously, you wouldn't want to do it for a small client, but a bigger client, definitely take advantage of something like that.
Yeah.
So we talked about penalties. Let's talk about the flip side. What about incentives? This is a very common question. I think something we get almost every time we speak is, what type of incentives for early pay do you see out there, Jody? And what would you recommend?
Yeah, typically a lot of the enterprise clients, if you offer them an incentive to pay, like let's say it's 1% for 15 days, they're required to take it. So they're required to take any type of incentive. So don't hesitate to offer that incentive, but think about that at the beginning. Make sure you build that into your price so that you're not just simply giving away your profit. 1% is pretty typical, 15 days. Some of the clients will, you can negotiate that. So the biggest thing with incentives is knowing really what AR days really does to your cash flow. The longer terms that you agree upon, that means you're being the bank for that amount of time. So be ready, because that's going to zap your cash or build into your line of credit. So the shorter period of cash, or the shorter period of accounts receivable, like 15 days or 25 days, or maybe even 40 days, is more realistic, but keep in mind you are still floating that money. So discounts are really important to bringing that down. And it's where you can actually get cash without actually having to increase prices or cut costs or anything. Like just simply accelerating that process, just making sure that you're there. So I'd say 1% is pretty typical for a 15-day. I mean, Jamie, have you seen anything else? Roger, have you seen?
Yeah, no, I think 1%, and I've often seen it go as low as 10 days, a 10-1. And I've seen a lot of customers take that as well. So, start low and see what kind of negotiations you can get. So, I wouldn't go much higher than 2% for sure, depending on, again, evaluate the profit, evaluate what type of team you have on it. If you're using your most expensive team, obviously you would want to be a little bit less there. If it's a cheap team or you're using, contractors or whatnot, you have to evaluate that. That's all part of the evaluation for sure.
Yeah, and I'd also say any kind of reoccurring revenue, set that up where it's just automatically taken out. So that's, every Monday or every once, the first Monday of the month or whatever the date is, because if it's a specific dollar amount that's coming out, there's ways that you can set it up to automatically just zap the client's account for that reoccurring revenue amount. But why send an invoice out and wait for payment? Just build that into your contract. That's just really part of what you do. And you'll be surprised how many clients have no pushback at all on that.
Yep, definitely. So you mentioned the word line of credit, Jody. So Audrey, I'd like you to dig a little bit into that. So obviously we recommend line of credits for all of our clients, but what's the size of the line of credit and what's that process of getting that secured?
So for purposes of line of credit, there's a couple of different suggestions we have. So for the amount, we always suggest having the same percentage that we have in your cash reserve. So that 10 to 30%, whatever percentage we decide on, that's how much we want to have for your line of credit. When you get it, this is a big one. Get it when you don't need it. Similar to, receivables, don't go knocking on people's doors when you need the cash. Go ahead and try to get the line of credit when things are looking good, you're feeling healthy, and you're not at a place where you're dying for cash. So just go ahead and have that, set in place. And yeah, those are really the basics.
So kind of adding to that, then if you're really thinking the R word's coming here soon, maybe it's time to get that line of credit today when banking relationships are solid versus,
Definitely.
During a recession when it's going to be really hard to get that line of credit even established. And so really important. Another thing is that why not get a 2-year renewal instead of a 1-year renewal? Talk to the bank and say, hey, I'd like to get a two-year renewal. What that means is that it gets renewed every 2 years, not every 1 year, which makes it even nicer. So if you do have that recession coming up or whatever, or that big issue where you may have a downturn in cash for whatever reason, you have that available and it's not going to really hamper your ability to actually continue with business. So get a 1 or 2 year, 2 years definitely preferable. And like Audrey said, if it's 10% that you need cash, the line of credit should be about 10%. But, if you can only get 5%, that's better than nothing. So it's not a do or die thing where you need to have that 10%, but it'd be nice too. And really, you want to use your cash reserve as your line of credit for the most part. That's the key there. That extra 5 or 10% that you have in your line of credit is only there in the event that you absolutely have a huge emergency where you have to actually utilize it.
And Jody kind of already clarified this, but one of the questions we got the last time we spoke was, does the line of credit count as cash? And the answer really for our purposes is no. It's, the line of credit, when you pull on it, it's a liability. It's not an asset for you. So that is something to take into account, as even though you have a line of credit, it doesn't necessarily count towards that initial 10 to 30% chunk of cash that we want.
Yeah, definitely. It's there for emergencies. I think that's the biggest thing is a lot of people will take that line of credit and use it as a loan and they'll have it drawn on all the time. Really it's your second emergency. Your cash reserve is your first emergency fund and then your line of credit is your second. So it's really important to use it as such and not to take that high interest all the time because that can be really expensive. So, So one thing we haven't talked about yet, Jody, we have just a couple minutes here. I want to make sure we touch on it is tax reserve. So can you talk a little bit about tax reserve and why it's important and how we calculate that?
Sure, absolutely. So everything we talked about was cash and how much money you have in the bank, that 10%. Well, that's assuming that you've got your tax reserve met. So don't include the money that you're setting aside for taxes as part of that 10%. So you need an additional amount. We typically put that into a separate bank account. The reason why we do it is because it's out of sight, out of mind. If it's in your operating account and you're looking at it all the time, it's really hard to use it or it's really easy to use it for something else. And so when it's in its own separate account, it's kind of set aside, hey, this is for Uncle Sam. We're going to go ahead and actually send this to Uncle Sam throughout the year. And so it's a kind of a separate, complete account. Typically, how you calculate how much money you need in that account is basically two different things. You need to know your last year's taxes, assuming you're a pass-through entity, you would need to know exactly how much estimated payments are required by the IRS. So if the IRS says, hey, that you're required to make 4 equal payments of, let's say, $50,000, well, then you need to know over a period of 1 year, you're going to need to make sure you funnel, $200,000 to that account. And the other thing, you need to know what your forecast is, because if you are actually growing in net income, growing your revenue over the prior year, well, that's not going to be enough money at the end of the year. You're still going to have a big chunk of money you're going to pay in April. And a lot of people confuse the fact that they're making estimated payments. They think all their taxes are all taken care of, when in reality, it's just the taxes that are being taken care of to avoid paying a penalty. And that's really it. And so knowing what your forecast is in advance is super, super important. So what you do is you take your forecasted net income, the bottom number there, which is typically for an agency between 15 and 20%, somewhere in that ballpark of your total revenue. And so you're taking that number, and let's say it's $400,000. And so you would take 40% of that, $400,000, and that's what we're going to estimate, or we're going to assume that you're going to pay in taxes at the end of the year. 40% is a good number. It may be high for a lot of people because the new tax laws lowered that tax burden for majority of the folks on this conversation. And then also you need to make sure you include your state taxes on top of that. So 40% is going to typically cover it, maybe a little too much. So 40% of that goes in there. We make sure that we pay the quarterly payments as go. We move money into that tax reserve account on a monthly basis, assuming we're going to hit our net income. The money gets zapped every quarter based on the coupon from last year. It builds. And at the end of the year, you should have the amount that you would estimate to pay in April sitting in your bank account. And so at that point, you've got that money set aside there. You've already made your quarterly payments. And so you're just waiting till April to make that final fifth payment then, assuming that everything is on. And the nice thing about the tax reserve account is that you're not sending it to Uncle Sam too quickly, because if you send it too quickly, you can't get it back. And so as you're going through, you're making your moving your monthly payments over to that tax reserve. You're making your quarterly payments to the IRS. If in quarter three you take a downturn, well, now we can pause maybe making that quarterly payment to the IRS. Maybe we can cut back a little bit on the tax reserve and make that up towards the end of the year. So there's a lot of things you can do. Please do not send that money to the IRS in advance of based on your estimated or your forecasted numbers. Send it out quarterly based on what's required, and make sure that you do hold things back a little bit towards the end if things aren't going as well as they were planning on going.
Great. No, I think we accomplished a lot in this podcast. I think there was a lot talked about, so I can imagine a lot of people listening just scribbling down notes, because I think there's a lot of key points to take away. So anything we missed, Jody or Audrey, that you want to make sure that the listeners get hold of on this conversation?
Just cash is king. You got to make sure that you have cash. Do not drain your accounts just to save money on taxes. That's the stupidest thing in the world. A lot of accountants have mentioned that to people in the past. There's tax reasons why you'd want to do that, but not for a healthy business. You want to build cash, keep cash in the business, and then keep that cash, the tax reserve set aside so that everything is taken care of. The only last thing about the tax reserve, and I didn't mention, is that some people will say, hey, well, I'll take care of my taxes personally outside of the company. If you're the sole owner, not a big deal. If you've got multiple owners and you want to make sure that none of your owners get behind on taxes, because that could put you in a position, again, risk your position, you want to do it inside the company and not outside. That's a lot easier to adjust things inside the company than it is to then adjust things outside, where you've got to say, a cash call and say, hey, I need everybody to pony up $100,000 next week, and good luck on that, because for the owners, they may have a pretty good grasp on it, but their owners' spouses may not, and then that's another conversation altogether. And so we want to make sure that if you have more than one owner, I recommend highly keeping that tax reserve amount and paying that out of the business as opposed to paying it personally.
What about you, Audrey? Any final thoughts on cash?
No, that was actually something that I was going to mention as well with taxes. It's something that we talk about specifically as it relates to our companies, but it's relevant for everyone. That make sure that, personally as well, that you're putting away money as the year goes on. It makes April a lot more enjoyable.
Yeah, definitely. I think this has been a great conversation. I think the key to me, and exactly what Jody said, cash is king. And we've worked with a lot of businesses between the three of us. I mean, the number of businesses is very high. And I can tell you there's a wide difference between the companies we work with that have cash and don't have cash. They're able to do so much more. They're able to be more aggressive. They're able to grow a lot quicker. So I'd say getting that cash reserve is the number one thing I would do if you don't have it right now. After listening to this podcast, I would go and build a budget and say, I need my cash reserve, and when can I get it by? Because it will change the way you sleep at night, and it'll change the way you run your business. So it's huge.
Absolutely.
So definitely want to thank Audrey and Jody for joining us. And I think, like I said, hopefully you took a lot of notes from this podcast, and we'll come back soon with another podcast with more metrics. Thank you.
Thanks, Jamie.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.